this video, we'll discuss the major characteristics of a corporation, as well as cover additional information about corporations, such as the formation and issuance of stock. It will conclude with a brief discussion on the two parts of stockholders' equity. A corporation is created by law. It is an entity separate and distinct from its owners. As a distinct entity, the corporation enjoys a continuous existence separate and apart from its owners. We can classify corporations in a variety of ways. Two common classifications are by purpose and by ownership. A corporation may be organized for the purpose of making a profit, such as Facebook or GE. Or it may be a nonprofit, charitable, medical, or educational corporation, such as the Salvation Army or the American Cancer Society. Classification by ownership differentiates publicly held and privately held corporations. A publicly held corporation may have thousands of stockholders, and its stock is traded on a national securities market, such as the New York Stock Exchange. Examples are IBM and Caterpillar. Whereas a privately held corporation, often referred to as a closely held corporation, usually has only a few stockholders and does not offer its stock to the general public. Privately held companies are generally much smaller than publicly held companies, although some exceptions exist, such as Cargill. A number of characteristics distinguish a corporation from sole proprietorships and partnerships. The most important of these characteristics are listed on this slide. The first 5 are advantages, whereas the last 3 are disadvantages. We will discuss each one in detail. As an entity, separate and distinct from its owners, the corporation acts under its own name rather than in the name of its stockholders. Facebook, for example, buys, owns, and sells property, borrows money, and enters into contracts in its own name. It also pays taxes as a separate entity. Since a corporation is a separate legal entity, creditors typically have recourse only to corporate assets to satisfy their claims. The liability of stockholders is normally limited to their investment in the corporation. Creditors have no legal claim on the personal assets of the stockholders unless fraud has occurred. In the event of bankruptcy, stockholder losses are generally limited to the amount of capital they have invested in the corporation. Ownership of a corporation is held in shares of capital stock, which are transferable units. Stockholders may dispose of part or all of their interest in a corporation by simply selling their stock. The same cannot be said for a partnership. The transfer of stock is entirely at the discretion of the stockholder. It does not require the approval of either the corporation or other stockholders. It is relatively easy for a corporation to obtain capital through the issuance of stock. Buying stock in a corporation is often attractive to an investor because the stockholder has limited liability and shares of stock are readily transferable. Also, individuals can become stockholders by investing small amounts of money. The life of a corporation is stated in its charter, and most corporations elect a perpetual life. Since a corporation is a separate legal entity, its continuance as a going concern is not affected by the withdrawal, death, or incapacity of a stockholder, employee, or officer. As a result, a successful corporation can have a continuous and perpetual life. The organizational structure of a corporation enables a company to hire professional managers to run the business, but the separation of ownership and management often reduces an owner's ability to actively manage the company. Stockholders legally own the corporation, but they manage it indirectly through a board of directors that they elect. The board of directors formulates the operating policies for the company. The board also selects officers, such as a president and one or more vice presidents, to execute policy and to perform daily management functions. As this chart shows, the CFO delegates responsibility to other managers, such as the controller and treasurer. A corporation is subject to numerous state and federal regulations. For example, state law usually prescribes the requirements for issuing stock. Publicly held corporations must disclose their financial information to the SEC through both quarterly and annual reports. Owners of sole proprietorships and partnerships report their share of earnings on their personal income tax returns. The individual owner then pays taxes on this amount. Corporations must pay federal and state income taxes as a separate legal entity. These taxes can be substantial. In addition, stockholders are required to pay taxes on cash dividends. So many argue that corporate income is taxed twice, often referred to as double taxation, once at the corporate level and then again at the individual level. A variety of hybrid organizational forms exist that combine different attributes of both partnerships and corporations. One type of corporate form, called an S corporation, allows for the legal treatment as a corporation, but the tax treatment as a partnership, so no double taxation. One of the primary criteria is that the company cannot have more than 100 shareholders. Other forms of organization include LLPs and LLCs. Corporations are created by applying to a state government. Upon approval of the application, the state issues a charter, sometimes called the Articles of Incorporation. The charter is a document that describes the name and purpose of the corporation, as well as the types and the number of shares of stock that are authorized to be issued. Regardless of the number of states in which a corporation operates, it is incorporated in only one state. The corporation establishes bylaws, which are simply the rules and procedures for the corporation. Authorized stock is the amount of stock that a corporation is authorized to sell per its charter. The corporation discloses in the stockholders' equity section of the balance sheet the number of shares authorized. A corporation can issue common stock directly to an investor or indirectly through an investment banking firm. Direct issue is typical in closely held companies, and indirect issue is customary for publicly held corporations. Par value stock is capital stock that has been assigned a value per share in the corporate charter. Years ago, par value determined the legal capital that must be retained in the business for the protection of creditors. The usefulness of par value as a device to protect creditors was limited because par value was often an immaterial amount, like a penny. As a result, many states do not require a par value. Instead, they use other means to protect creditors. No par value stock is capital stock that has not been assigned a value in the corporate charter. No par value stock is fairly common today. In many states, the board of directors assigns a stated value to the no par shares. Owner's equity is identified by various names: stockholders' equity, shareholders' equity, or corporate capital. The stockholders' equity section of a corporation's balance sheet consists of two parts. First is paid-in capital or contributed capital, and the second is retained earnings or earned capital. The distinction between paid-in capital and retained earnings is very important. Corporations can declare dividends out of retained earnings in all states. However, in many states, they cannot declare dividends out of paid-in capital. Paid-in capital is the total amount of cash and other assets paid into the corporation by stockholders in exchange for capital stock. Retained earnings, as its name implies, is net income that a corporation retains or reinvests in the business.